I'd like to start straight away by asking about your time in Fortis Bank when you were last here in 1998. What's the difference between then and now?
Well, I guess, if we look at the key difference, I think oil prices in those days, 98, we're looking at $10 a barrel. And we have seen very recently up in the high 140s, now coming off somewhat. So it's an enormous difference what we have seen in the market, in the demand growth and development, also in the refinery side, enormous investments in storage.
When you came here, oil was $10, as you just mentioned. How difficult was it then to do business as an oil trade financier?
To be very honest, in the days when we started here first, we were still not part of the Fortis group. So in those days, actually, towards the large refinery companies, to explain who Mace Pearson was far more difficult than if you are telling them Fortis, who's a AA rated company. And I think that really created for us a big increase in our energy markets, both on the corporate side as well as on the commodity trade finance side. And that gave us a very large entry ticket and resulted in the very large increase of our portfolio, which basically meant that we are giving competitors like BNP Paribas a real run for their money. And I think that's been overall very good to the customers.
You were here between 1998 and 2003.
That's correct.
And I think you helped set up the whole Fortis brand and the business for the oil trade finance sector.
Well, I'd like to say I played a part in that. I think there's always a global activity. And in those days when I was the head of the commodities business in Asia, and that played an important role. But I think nowadays we are looking at more from an integrated approach. We've tied into that our corporate energy and oil and gas activities, the commodity activities on the energy side, as well as our transportation activities. Because basically we are talking about integrated flows. What we've seen is that the larger players have moved from asset light to asset medium. So large oil trading companies have taken on board investments in storage as well as in shipping, and I think that allows us to play a much bigger role for our customers.
So during those 5 years when Asia was, so to speak, in trouble, the economies had collapsed and oil was $10, how did you go about building up the company during that early 5 years?
I think it's in some ways it has been quite straightforward and simple. It has always been a client focus, focusing on what our customers are doing. So if our customers were moving to new areas or new activities, we would follow them. And I think the example of that is that our customers started to invest in storage, started to invest in shipping activities, and it was bringing those products and resources together. And I think what we're looking forward to the future, and also I think what our remit in Asia will be, is adding into the investment banking capacity. We will, if you look at, for instance, the E&P opportunities in Asia, we do expect ultimately more M&A activity. We expect some of the companies to look more at funding from an equity point of view, which means that you're going to be looking at IPOs. I mean, people like Chemoil, as an example, did an IPO in Singapore because it's an attractive market to do so.
Right. So, from an oil trade finance role, the bank started to follow the clients and build up a bigger portfolio for their activities.
Correct.
Okay. Now, between 03 and 07, that was the second phase I was going to look at. How would you describe that period? Was it a period of uninterrupted growth? Did the bank have a good run in Asia as far as oil trade finance, oil project finance were concerned?
Yes, absolutely. I mean, I think we were all, and it's not only Fortis. I think the other financial players in that market, as well as customers, were of course helped by the fact that since 2001 we've really seen a boom in the commodity markets. Partly explained by, of course, the dollar that has gone down, which is usually pushes up the commodity prices, and we've particularly seen that on the energy side. But more importantly, also the enormous demand increase that we've seen in India and in China. And I think in that period, if you look at the new demand that's come out onto the market and growth, 2/3 of that is approximately Asian-based. So that certainly helped our business tremendously.
Commodities is a very wide area. So oil is of course one of them. What are the other commodities you handle?
On the commodity side, has of course been the metals. Metals has been a very strong development as well. Again, the enormous demand coming from China as well as India.
Precious as well as basic metals.
We look also at the basics. If you look at the steel, if you look at the aluminium, and on top of that, which we've seen the last few years, and agricultural commodities always tends to have a lag in that respect to the energy and to the metals complex, that has also grown very, very significantly. If you just look at what's happened to soybeans, if you look at rubber prices,
rice.
if you look at rice, the palm oil, and of course the palm oil also again ties back into the energy because of the biodiesel issues that we have seen.
Right. In the beginning, oil was the bulk of your, or provided a big chunk of the business for your oil trade, commodity trade finance business. Currently, is oil still as huge, or the other commodities catch up?
Actually, I think if you go back, I think oil has been the one that has grown significantly, but it was initially not as large as it is today.
Okay.
And that's of course been built up through the price. So I would say that from an Asian perspective, actually, the sizes of the businesses, the three businesses, at least if you talk about the commodity size, are approximately the same size.
About a third each?
Yeah, it's not far from that. I mean, there's you would find in Hong Kong and Shanghai more of a focus on the metal side. Singapore is predominantly, of course, energy. Then we see Dubai growing quite significantly in that. And if you talk about more on the project finance side, if you add in our global export finance as well as the corporate energy and the oil and gas exploration, we see that now increasing significantly also in Singapore as well as Australia. And Australia is an office we opened very recently, being driven primarily actually by the expectation on the energy market.
This is which city are you operating out of?
We're operating out of Sydney there.
Sydney, right. And that office will take charge of all commodity financing matters.
If you talk about the Australian side, yes, and so it's that is driven actually more by the energy corporate side, and commodities is a business we will start in the coming year. Right. So that's still small. I mean, primarily driven out of Singapore and Hong Kong.
Australia will be mostly an upstream play rather than a downstream and logistics play.
Yeah.
As we speak today, we have a couple of crises facing the world. One is the credit crisis, which is, I understand, affected a lot of business operations. How do you operate in such a business environment? People are going to come to you for money. It's I think you're in big demand now. So how do you assess them? How do you provide money to them?
Well, it's indeed it's a challenging situation that we've seen since last year with the subprime debt, which is creating, of course, significant pressure in the financial market. On the other hand, you've seen, of course, the energy prices, you've seen commodity prices, as an example, increasing sharply. So I've always called them actually twin shocks, and certainly from a customer perspective, because I think all financial players are encountering the effects of the credit crunch, the impact of subprime, which is basically increased pricing in the market. Because there is less liquidity, people are more conscious about what the impact could be of the credit crisis. And on the other hand, you have the very high energy prices moving up even to around above the $140 mark per barrel. And of course that puts a lot of pressure on being able to cater to the demand of your customer. But I think what we've seen is that it's being rationed as a result of prices moving up in those markets. But indeed, it's a challenge.